Okay, at this point, we have covered assets. We talked about cash and how you protect cash. We've gone through accounts receivables and how you report accounts receivables, gone through inventory. We've looked at fixed assets, property, plant, and equipment, and tangible assets. We've looked at liabilities. So now we're going to look at the third leg, which is equity. Now, all public companies are C corporations, and that's just the section in the tax code that designates them as C corporations. A corporation is an entity separate and distinct from its owners. It's created by law, and this is state law. It is not federal law. There are federal taxes involved, but a corporation is created by state. And a lot of corporations seek certain states that are advantageous. For instance, Delaware is a big state where companies incorporate because apparently they have laws that are favorable to corporations. Because they're an entity separate and distinct, they have most rights and privileges of a person. So they can be sued, they can enter into contracts. They're subject to the same duties and responsibilities as a person. And again, because they're a corporation, a corporate or an entity, separate entity, a corporation has to pay income taxes, and then they provide dividends to their employees, and those dividends are taxed not to their employees, to their investors, and those dividends are taxed to the investors. Although, depending upon the length of time that you have the dividend, it could be a reduced rate. Okay, so characteristic corporation, they can buy, own, and sell property. They can borrow money. They can enter into legally binding contracts. And again, they pay their own taxes. Limited liabilities of stockholders. This is one of the advantages. The liability of stockholders is limited to their investment in the corporation. And this has been around for a while. In fact, the British had these types of corporations that were involved in the founding of America. Of course, they were supposed to make money, and a lot of these ended up going out of business. But if a corporation gets into trouble, if a corporation is sued, the stockholders do not have to pay the corporation's debts, and they're not obligated personally. So that's limited liability. The only thing that you would lose would be the value of your stock, because if something bad happened, then the stock would go down. Creditors have no legal claim on you as a shareholder. Uh, Shareholders may dispose of part or all of their interest in a corporation by selling their stock. This is an important point. The shareholders own the corporation. The shareholders own the corporation. So I own part of Apple, and I own part of Amazon, and I own part of Nvidia. So I am a part owner. Now, I don't own enough to make a difference. And if I called up the president, he wouldn't take my call, but I'm a owner of the corporation. So I get dividends and stock appreciation, but I can transfer my ownership part or all of it just by going online and telling my broker to sell some shares. In fact, I did that this morning. You can acquire capital, and that's one of the main reasons to be in a public company is you can acquire huge amounts of capital, billions of dollars, so that you can use that to grow your corporation. Continuous life. If the president dies, well, they just have a new president. If you're a sole proprietor, well, then your business is and you're out of business. So you have continuous life. If I die as a shareholder, my shares will pass to my wife, and then she can do with whatever she wants. As I mentioned, shareholders, stockholders legally own the corporation, and you own The percentage of your shares is the percentage of your ownership. So if you own 5% of the stock, you own 5% of the corporation. The shareholders vote on the board of directors. So we vote on who is going to be in the board of directors. The board of directors then will hire the president, the chief executive officer, and a lot of the officers, and then, of course, they will hire other people. So the shareholders will elect the board of directors, who then appoints chief executive officer and president, and then they will appoint these other people. The board may be involved in some of these decisions depending upon how high up it is, how big the corporation is, etc. Um, State laws. So when you incorporate, you have articles of incorporation. It tells you, well, here's our structure. Here are the number of shares that we can issue, etc. So those are the bylaws, and that's what you file with state laws. Okay, again, the corporation is a state entity. Federal laws, again, if you're going to sell stock on the public exchanges, you have to deal with the Securities and Exchange Commission. They pay federal taxes, as I mentioned, and then stockholders must pay taxes on cash dividends. So here are the advantages and disadvantages. You probably should know this. Other forms, S corporation. That is a corporation. A lot of times it may be you have a limit to, you can only have less than 100 shareholders. You can't have any foreign residents that own the stock. You have limited partnerships, limited liability partnerships, limited liability companies. A charter, the corporation is formed by grant of a state charter. So you go to the Secretary of State and you give them some money, probably, and you file who your representative is, and then your charter. The bylaws establish the internal rules and procedures. A license must be obtained from each state in which they do business. So there are costs to organization, legal cost, stock issue cost, etc. So stockholder rights. Well, you get to vote on the board of directors. You get a share in the profits through dividends. You have preemptive right, which means that if the corporation decides to issue more shares, they have to give you the right to maintain your ownership percentage. So if you own 14%, then they have to first give you the right to buy 14% of the additional shares so that you maintain your ownership. Can't afford it, then sorry, you're out of luck. And then you have residual claims. But, if a company goes out of business, they're not doing well, and you're probably not going to get much anyway. All right, so you need to know this. There are going to be three different levels of stock. Authorized means we can sell 1 billion shares, but it doesn't mean we're going to sell 1 billion shares. So the authorization of capital stock doesn't have any effect on the corporation or the accounting, other than it's just a note that says, hey, we can sell this many shares. When you issue stock, that means you've issued. Okay, so that means that there is stock out in the public's hands. So authorized means the number of shares you can issue. Issue is the number of shares you've actually issued. And normally you have an underwriter like JP Morgan or Bear Stearns or companies like that will help you, help you go through the process. They'll charge you millions of dollars, but they'll help you go through the process. They may line up investors to make sure that the stock is sold. And they're called underwriters. Par value is a capital stock the charter has assigned a value per share. Not commonly used nor required by many states, but it does require a difference in the way that you record the stock. No par value is capital stock to which the charter has not assigned a value. That's fairly common today. Indicate whether each of the following is true or false. If false, indicate how to correct the statement. Similar to partnerships, in a partnership, stockholders of a corporation have unlimited liabilities. That's false. They have limited liability. It is relatively easy for a corporation to obtain capital through the issuance of stock. I'd say that's true. Separation of ownership of management is an advantage of corporate form of business. Isn't. You have professional ownership, but you know they're working. They're not. They don't have skin in the game, so to speak. Except they usually do. They're given skin, so that aligns their motivation with the shareholders. The authorization of capital stock decreases stockholders' equity. No, actually, it's the reverse. All states require par value. No, no par value is required. All right, so you have paid in capital, and that is the amount of cash and other assets paid in the corporation for stockholders in exchange for capital stock. Again, shareholder equity is paid in capital and retained earnings. Retained earnings is the amount of profit you have kept in the business. So it's profit less your dividends you paid. At the end of the first year of operation, the World Corporation had 750,000 of common stock, net income of 122,000 of dividends. So basically, you would have paid in capital 750, retained earnings of 122,000, total equity of $872,000. Now, when we issue stock, what happens is that's when the company gets their money. So when you issue the stock, that's when the company gets their money. And that is the figure that is put onto the company's books. So if they have 1 million shares and they sell it for $10 a share, and the company gets $10 million less some fees, and that's the figure they put on their books as paid in capital. And the exchange of stock day to day doesn't involve the corporation. That involves people that are going to buy and sell stock. I sold stock this morning, and so somebody out there bought it, but it wasn't the corporation. Although the corporation can and does buy stock, and we'll talk about that. That's called treasury stock. So again, if you're issuing par value, you have to separate and do an entry that has, okay, so if I sell it for $10 and the par value is 1, then I'm going to have two sections. I'm going to have paid in capital of the number of shares times the par value, and then paid in capital in addition to par would be the remainder. It has no impact on how much you get. It's just the way you record it. So I'd have paid in capital common stock, paid in capital in excess of par, but you still get $6,000. Cayman Corporation begins operations March 1st by issuing 100,000 shares of $1 par value common stock for cash at $12 per share. All right, so we're going to take $100,000 at the par value, so that's going to be common stock, par value $1. And the remainder is going to be paid in capital, so that's 11 times 100,000, so that's 1.1 million. And we'll just look at the first one there so you can see that you're getting 1.2 million, but you have to divide it on your books. I don't know why, really. Okay, so treasury stock. What is treasury stock? All right, so we have authorized. That's how many shares we can. Issued. That's the number of shares we've actually sold. Excuse me. Treasury stock is a company buying their own shares. And so issued and outstanding is the third part of this. Issue and outstanding is the number of shares that are issued, and what you subtract from that is the number of shares the company has bought. So they bought their own shares, all right, and they do it because they may give it to the officers and employees under bonus and stock compensation plans. They may do it to increase the liquidity of the stock to get people trading it. They may think their stock is very undervalued, so they say, hey, we're going to buy the stock. We're going to put it in our treasury, i.e., the term treasury stock. And when the market goes up, which we have confidence it will, we'll sell the shares back to the market and we'll make the profit. Nothing wrong with that. You have confidence in your company. You're building it, so you make a little money on or a lot of money on your own shares. Or you can reduce the number of shares outstanding and therefore increase earnings per share. So earnings per share is earnings divided by the weighted average number of shares. If you have less shares, that means you have more earnings per share. So there are reasons to do that. But again, you have Cost method, you just basically, we're not going to go a lot into the accounting for this, but basically, again, you see here, you've got the par value, you've got the remainder, which is, or well, it is par value, and it was sold. Okay, 400,000 shares authorized, 100,000 shares issued and outstanding. So this company doesn't have any treasury stock. All right. So now they have purchased $32,000 of shares, 4,000 shares. All right. And that reduces your shareholder equity because you have less shares out there. And so you've bought that shares back. So you've got retained earnings. And so you've got total paid in capital retained earnings. And then you subtract the shares that you have purchased. And so that reduces stockholder equity. So the purchase of treasury stock will reduce stockholder equity. So Santa Anita Inc. purchased 3,000 shares of its $50 par value shares for 180. And you really have to separate this into, okay, so that's treasury stock. All right, dividends. You have dividends which can be paid in cash, or you have dividends that can be paid in stock. I'm not a favor of dividends paid in stock because I think it's just, why bother? It doesn't really make your stock worth any more. And so I don't know that a lot of companies do that. We'll have stock splits, which I'll talk about. A dividend is just a distribution by a corporation to the shareholder. And really, that is three things you have to worry about, okay? And that is the declaration date. That's the date the board of directors says we're going to pay a dividend. And at that point, you have created a liability. And so you have to do a journal entry. And that would be dividend expense and dividends payable. Then you have the record date. And so the record date means that whoever owns that stock at 5 o'clock is going to get the dividend. And so it takes them a while to determine this. You may have thousands and thousands of shareholders. You've got to identify each one and how much stock they own. So you got to have a cutoff date. And so that means that if the record date is January 31st, anyone that owns the stock up to January 30 or on January 31st at 5 o'clock, they get the dividend. If they sell their shares on February 1st, they still get the dividend. So if there's a question to go, who gets the dividend? Well, who owned it? Who owned it on January 31st? So if the question says investor A sold the stock to investor B on January 30th and the record date is the 31st, well, investor B owns the stock on the 31st, so they get the dividend. If it says investor A sold the stock to investor B on February 2nd, well, investor A owned the stock on January 31st, they get the dividend. And then the payment date, of course, is when you receive your funds. So there's no journal entry on the record date, but there is a journal entry on the payment dates, which are going to credit cash and you're going to debit the dividends payable. Preferred stock, I'm not a big fan of it, so I'm not going to talk much about that, but it just means you get preference in some way. And sometimes it means that you have to get a dividend. And that if you miss a dividend, then you have to pay dividends in arrears, although that's not considered a liability because you don't have to pay them. Stock dividends, again, just means, well, if you have 100 shares, we're going to give you 20% stock dividend. And so now you've got 120% shares, but your shares price will go down to reflect that. So you're no better off unless it signals to the market that they think you're going to do better. All right. So now stock splits are something that just says, in fact, I own some NVIDIA stock. They're going to do a 10-for-1 stock split. So the price is around $1,100 a share. They're going to give me 10 shares for every one share that I own. But that also means that, again, it's going to go from $1,100 a share to $110 a share. Why do they do that? Because, well, one, you should look up Berkshire A. Berkshire A is a stock that has been around and they have never had a stock split. I looked at this stock years ago. It was $4,000 a share. As I look at it today, it's now $620,000 a share. How many of you can afford to buy one share? $620,000. I know I can't. Well, maybe I could, but anyway, um, it allows more people to buy the stock. So if you wanted to buy shares, and you can buy fractional shares, but the reality is if you wanted to buy stock, $1,100 for one share, I got to come up with some money. So now we're going to have more shares, but the share price is going to be less. So we open it up so that more people um, are able to buy the stock. But the company doesn't do any recording on the stock splits. Okay, so we're going to buzz past this, but there are going to be some things that we want to look at. Well, that's just, you can see how the equity is shown on the balance sheet. You can have these payout ratio, so that's what percentage of your profit do you pay out. Earnings per share is the main determinant of long-term shareholder growth and stock price growth. And so that is something that we will start talking about when we talk about analyzing companies. So we're going to go through that. So, all right. So that really should cover that. The main things to remember here are one,